Chapter 7 is on stock valuation, and there's two ways to go about stock valuation. There's some simple models that directly calculate the value of a share of stock depending on the dividends, and then there's going at it from calculating the value of the whole company and backing into the stock price, and that's the more complicated, but we're going to start with that way first. So that's called the free cash flow model. And so there's two versions, the constant growth and non-constant growth, if the firm is experiencing constant growth rate or non-constant. And then the direct stock models, or the dividend growth models, same thing, constant growth and non-constant growth. And what you'll find is that the two methods are identical. The only difference is what's in the numerator. And then a third way to come up with a stock price is using multiples of comparable firms. If a stock is publicly traded, this method is not necessary because all we have to do is look at the market and see what it's selling for. But for private companies or companies going public, this is a very useful way to come up with a price of a share of stock, is by using multiples of other publicly traded firms, earnings, sales, something like that. So remember from chapter 2 what free cash flow is. Free cash flow, remember, was NOPAT minus the change in operating capital. And it's the capital that's available for the distribution to all of the company's investors. Okay, so all of the expenses have been paid, all the buying of assets has been done, and so this is free cash flow. It's not needed in the company, and so it's available for the investors to take out of the company and do something else with. So we forecast those free cash flows, and then we discount them at the weighted average cost of capital. And the WACC is simply the company's overall cost of raising money. So how much debt do they have? How much equity? How much does each one cost? That's the weighted average cost of capital. So this is the general formula for the present value of a perpetuity. So the present value of expected future cash flows, if they're constant, discounted at the WACC, is a stream of cash flows here from 1 to infinity. Okay, so infinity is a long time, but so that's going to give you the value of operations, and to that the value of operations we're going to add any non-operating assets that the company has, like marketable securities, non-controlling interest in other companies, anything else that is of value on the balance sheet but it's not part of operations is obviously added to this to get the value of the company. And then on the right-hand side of the balance sheet, we have to take out the debt holders have first claim, preferred stockholders have the next claim, and so anything left over belongs to the common stockholders, and that's going to be the basis for the stock price. So if we look at this is like the balance sheet, the value of operations is obviously in most companies going to be the bulk of the value of a company. So this company, the value of operations gives you all this, and then they've got some marketable securities that increase their value a little bit. On the right hand side, they've got equity, they've got debt, and they've got preferred. And obviously the two circles are the same size because the balance sheet has to balance. So the value of operations, again, is the present value of the future cash flows discounted at WACC. And so this is an infinite stream, and infinite is a long time, like I said. And so we're going to use the shorthand formula, present value of a perpetuity. So the value of operations at time 0 is equal to free cash flow 1. So this is important. The value at any time is equal to the free cash flow at the next year. So the value at time 5 is equal to free cash flow 6. The value at time 24 is equal to free cash flow 25. So it's always the next cash flow in the numerator here, divided by WACC minus G. Okay, these numbers are from the mini case in your book on page 339. I don't know if you need to look at your book, but you can open it if you want in case you forget something as we go through this. So this is all given in the problem. And so there's free cash flows at time 0 of 24 million, WACC's 11. Free cash flows are expected to grow at a constant rate of 5%, and then they've got short-term investments, debt, preferred, and 10 million shares outstanding. So the first thing we have to do is find the value of operations. So the value of operations at time 0 is free cash flow 1 times what, or divided by WACC minus G. So 24 times 1 plus 5% growth is going to give us free cash flow 1 divided by WACC minus G. So the value of operations is 420 million. Okay, this is the present value of an infinite stream of cash flows that starts at 24, grows at 5% a year, and is discounted at 11% to the present. So the total value of the company then is that 420 plus the $100 million in short-term investments that they have. So this is what the whole company is worth, is 520 million. Okay, from that we're going to subtract the debt and the preferred stock. So the value of the equity is 270 million. Okay, and if there are 10 million shares outstanding, then the stock price is $27. Okay, this forms the basis for what we call value-based management. We've gone from the income statement and the balance sheet to a stock price. And so if you kind of think ahead, if you don't like the stock price, then what can we change in the inputs to make our stock price better? So then in the problem it goes on to talk about, okay, what if growth is not constant? So here you can see that we don't have a constant growth rate going on between these 3 years. So when growth is non-constant, we have to forecast the free cash flows out one at a time until we get to where we can see constant growth in the future. As soon as we can see a constant growth rate, we can use that present value of a growing perpetuity model that we looked at before. Okay, so we forecast the free cash flows out for as long as we have non-constant growth. As soon as you can see constant growth, you calculate a horizon value at that point in time, and then you're going to add the cash flows together in that year and discount them all back to time 0. Okay, so here's our cash flows years 1, 2, 3, and then obviously year 4 is this times 1 plus 5%. Cash flow 5 is 4 times 1 plus 5, and so forth. Okay, so again, we're going to use our shorthand and say, okay, at time 3, I see constant 5% growth in my future. So the value of operations at time 3 is going to be equal to free cash flow 4 divided by WACC minus G. Okay, so 35, go back one more, 35 was cash flow 3. Okay, so 35 times 1 plus 5% is cash flow 4 divided by WACC minus G. So this gives us 612.50. This is the horizon value at time 3. Okay, so here's a graphic, but I'm going to switch to Excel in a second because I like Excel way better. You're never going to, I do not want you to do this. I don't want you to divide by these things. I want you to use the power of Excel. But so cash flow 1, cash flow 2, cash flow 3, and then value of operations in time 3. So let me go to my Excel spreadsheet here. So I put in the 3 cash flows, and then you can't see my formula up here, but it says M6, so that's the 35 times 1 plus 5% in parentheses divided by, in parentheses, 11 minus 5%. Okay, so the horizon, so you've got to be really careful with your parentheses in Excel. So the horizon value is $613 million. So then the total cash flows are 10, 20, and 648, right? Because time 3 is 35 million in time 3, and this represents the present value of year 4, 5, 6 to infinity. Okay, now let me delete this and do it again for you. So if you go into the function wizard, f of x, and go to financial and scroll down to NPV. Now in a good spreadsheet, I would have typed in my inputs over here, and so I would just point and click at cells, but I didn't bother. So the rate was 11%, and in Excel, you know, we use decimals. And then the values I just highlight right here. Okay, so remember that Excel treats the first number it sees as time 1, which in this case is perfect. And so then I just say okay, and my MPV is 480.67. Okay, I do not want you to ever do what that slide shows where you're dividing stuff by hand. There's no reason. Excel is powerful and awesome, and I want you to use it. So we got the same answer, but my way was easier. So the value of operations then 480.67. Just like before, then we add the short-term investments, we subtract the debt and preferred, and we divide by the number of shares, and we get a new stock price of 33.07. Okay, so this stock price is higher than it was before. Last time it was $27. Okay, so these new assumptions give us a higher stock price of 33.07. So again, the horizon value is the value of all the free cash flows from year 4 and beyond, discounted back to year 3. Okay, And then the present value of the horizon value is the present value of all the free cash flows from year 4 and beyond. So at time 0, the present value of the horizon value is the present value of those cash flows. But again, you're never going to be doing this in isolation. You're going to find the present value of all the cash flows together. Now here's the interesting thing. By far, and this is always true, the majority of the value of a company comes from that horizon value term. And so, what you assume for the long-term growth rate has a huge impact on the value of a company. So in this case, the horizon value is responsible for 93% of the value of the company. So that horizon value is a very, very important number in the valuation when you're trying to figure out what a company is worth. So why do companies focus on quarterly earnings? All the time you see companies making quarterly earnings announcements, and it's a very big deal, and the Wall Street Journal covers it, and they announce it on the financial radio. So if the value of the firm is the present value of the future cash flows, why is everybody so focused on quarterly earnings? Well, two reasons, a good one and a bad one. So the first one is the good one. Changes in quarterly earnings can signal changes in future cash flows. And so if there is something that it caused the earnings to be lower than expected, then that's going to cause analysts to revise their expectations, perhaps, of all the future cash flows. And so if quarterly earnings disappoint, it might be a signal that the whole stream of cash flows is overstated. And so analysts will revise and the stock price will go down. The other reason is the bad reason, and that's that very often management has bonuses tied to quarterly earnings. And so they're managing the earnings to try and get their bonus higher. And so that's a problem in the incentive system. You don't want to tie managerial bonuses to quarterly earnings because that will cause you to do perhaps, possibly even illegal things to inflate your quarterly earnings. So, simple approach, forecast sales. Okay, so we had free cash flows. So we're going back a step and saying, how do we get to free cash flows? So a very simple approach is to say, forecast your sales at whatever growth rate you think sales are going to grow, and then go straight from sales to NOPAT. So what percentage of sales is NOPAT historically? So it all depends on the sales forecast. So forecast your sales at whatever the right growth rates are, forecast NOPAT at whatever historical percentage NOPAT is of sales, and forecast total net operating capital as whatever the historic percentage of sales net operating capital is. Okay, so this is still in the mini case. So let's say we have sales of $2,000, total net operating capital of $1,120, and our NOPAT to sales ratio is 4.5%, and our operating capital to sales is 56%, and the WACC in this one is 9%. Okay. So we're going to forecast that the operating ratios remain unchanged. Sales are going to grow at 10, 8, 5, and 5 for the next 4 years. And so the long-term growth rate in sales is 5%. Okay. So there's all of our inputs. Okay. So these are our growth rates in sales. NOPAT's 4.5%. Operating capital is 56% of sales. Okay. So for our forecast, sales in year 1 will be 2,000 times 1 plus the 10%, right? NOPAT's 4.5% of sales. Operating capital is 56%. And so then free cash flow is NOPAT minus the change in operating capital. So if we look at some numbers here. So we started at time 0. Now the assumption always in finance is that time 0 has happened. And so time 0 is not part of the forecast, but we need it here because we need this number. So here's our sales growing at the rates that we specified in the assumptions. Here's our NOPATs that are 4.5%. Here's our operating capital that is 56% of sales. So our free cash flow then here is 99 minus the increase in operating capital, right? And so this one is 107 minus the increase here between these 2 years. Okay, so our free cash flow is what we want in each of these years. And so free cash flow is actually starting in year 3. It's growing at 5%, but we're going to go with this right here. So here's a problem right off the bat. NOPAT divided by operating capital is ROIC. So the ROIC is constant at 8%, but remember what the WACC is. The WACC is 9. So what you're saying here is we're raising money at 9 and investing it at 8. So that's not a good thing. This is going to cause our stock price to fall, right? So we have to earn more than the WACC to get ahead, to have an increase in value. So the horizon value at time 4, okay, is going to be equal to this last free cash flow of 48.025 times 1 minus 5%, 1 plus 5% divided by WACC minus G. And that's going to give us a horizon value of 1,260,000. Okay, that's at time 4. And then here again, they did it separately. You would just do it in Excel and do it in one fell swoop. But doing it this way, what you can see is what an important part of your total value, the horizon value, is. So the present value of all the cash flows then gives us a value of operations of 958. Okay, so what are the value drivers? Well, obviously they're the things that we forecast. So the value drivers are the sales growth rate, the operating profitability percentage, the capital requirements, and the cost of capital. So these are things that you can change. So if you're not happy with this operating value of 958, then focus on growing sales faster, cutting your expenses, doing more with less, or your cost of capital. All of those things can have an impact on value. So if we look here, so we're just going to change one thing. We're going to change the growth rate. So we're going to hold operating capital and the capital requirements the same and the WACC the same. But we're going to increase growth to 11, 9, 6, 6, and 6. And so if we go through that, we find out that the value of operations actually goes down. And so you're like, wait a minute, how can growth value go down if we grow faster? Well, the problem is that, again, the ROIC is less than the WACC. So growth is a bad thing. If you're losing 1% on everything you do, growing faster is not going to solve your problem. And so you've got to solve this problem first. You've got to solve the ROIC problem before you can have growth. So here we're going to hold the growth rates constant, but we're going to improve the operating margin to 5.5 from 4.5%. So how do you do that? By cutting expenses. So is there some way that you can improve your operating profitability by cutting expenses? If we do that, look what happens to the value of the company. So it goes from 958 to 1523. Okay, obviously a good thing. And our ROIC went from 8 to 9.8. So now we're earning more than the weighted average cost of capital, and that's why our value goes up. So now let's see what happens if we do something about the capital intensity. Can we do more with less? So everything is held constant except the capital ratio. So we're going to lower the capital ratio from 56% of sales to 51. So this is by being more efficient with your assets, okay? Selling more for a given level of assets, cutting non-performing assets, lowering your accounts receivable, your inventory, something like that to make your assets less. So this is not as impactful as improving the operating margin, but it helps. But we're still below 9% here. And so it increases the value of operations, but we still are not earning above the cost of capital. So it's better than an 8% ROIC, but it's still not good. Okay. So impact of simultaneous improvements. Okay, so let's improve the operating profit margin and the capital requirement, and then we get up to 7, and that improves our ROIC to 10.8 and improves our value to 1756. Okay, so this is why you can see they're called value drivers. It's how we can change the value of the company by managing the financial statements. That's value-based management. And so here, if we could do all the things, improve the growth while improving our profit margin and improving our capital requirements, then we're going to go from 958 to a whopping 2,000,008. Okay, and that's because we've got a bigger ROIC than the WACC now. Okay, so this is how you create value. This is how you improve value in your company, how you measure it and improve it. Okay, so here's kind of a summary of what we just did. So the value of operations at all these different ROICs if growth is 5% and 6%. And so you can see how it improves by improving the ROIC and then improving the growth rate. So here at 8%, you actually destroy value by growing. Okay, here you do improve it because you're getting close to the 9%, and then here you're seeing bigger improvements. So when ROIC is low, increasing growth reduces value. When growth is low, increasing ROIC adds value. And then when ROIC is high enough, increasing growth adds enormous value. So I'm going to stop this one right here, and then I will do another recording on the stock price valuations.